There is a romance in the idea of doing it yourself. The myth of the young investor hunched over a phone, thumbing through candlestick charts between lattes, belongs to the same cultural lineage as the frontier farmer, rugged, independent, beholden to no one. Apps whisper encouragement, social media supplies conviction, and in the frictionless glow of the screen, it feels, almost, that finance has been democratized. Why pay an advisor when the market is right there, open to all? But independence can be deceptive, and in markets, as in war, the untrained often serve as cannon fodder. The post 2008 generation of investors has grown up in the longest bull market in history. Stocks rose, bonds yielded little, and money, cheap, abundant money, sloshed across every corner of the economy. To buy an index fund was to make money. To buy a meme stock was to make more. Success bred the illusion of skill, and skill the illusion of safety. But what looks like mastery in a rising tide is often nothing more than luck in disguise. Professionals, hedge funds, trading firms, even the patient institutions of endowments and pensions do not mistake luck for permanence. They deploy research teams, tax engineers, algorithmic models that sniff out basis points the way hounds sniff blood. They operate at speeds and scales inaccessible to retail investors. The lone 20 something with a Robinhood account may feel empowered, but he is not competing on level ground. He is being invited to the front line without armor, a volunteer in someone else's campaign. The problem is not just sophistication, it is psychology. A bull market teaches investors to believe in themselves, a bear market teaches them to doubt. When markets swoon, DIY portfolios often disintegrate, their owners selling in panic, then buying back in too late. Without an external check, an advisor to slow the hand, to remind the client of goals beyond the week's headlines, the cycle of fear and greed repeats until the compounding miracle of time is squandered. What's missed too is context. Investing is not an island. It is braided with taxes, debt, estate planning, insurance, liquidity, domains that rarely surface on a TikTok video about the next Amazon. A young investor may celebrate a doubling stock only to discover at tax time that his short term gain has been gutted, or that he sold shares he needed for a down payment, or that he locked himself out of institutional funds by structuring accounts improperly. The market is rarely kind to the inattentive. This is why the metaphor of cannon fodder lingers. Not because young investors are foolish, but because they are brave in the wrong way, charging into a battlefield with enthusiasm but without cover, while professionals, armored and entrenched, wait for the smoke to clear. The tragedy is not that they lose. It is that they could have won slowly, deliberately, with the discipline that compounds wealth across decades. What seems at 25 like a harmless experiment can at 45 look like a wasted decade. And in finance, unlike in war, there is no memorial for those who mistook courage for strategy.